So good morning once again. This is a 6314 class, so we don't need to waste much of our time. So let's start. So permit me to share my screen. Please, can you see my screen?
Yes, sir.
Thank you. So we
Yes,
stopped after study session 3. So we start from study session 4 today by God's grace. So and this study session 4 talks about deferred tax. So deferred tax. Before we start this topic, I want to quickly say something on deferred tax. When you look at deferred tax, you discover that this deferred tax is strictly concerned with IAS 12. And IAS 12 is income taxes. Income taxes. No IFRS has been published on deferred tax. So we are still making use of IAS 12. And IAS 12 is what? Deferred tax. So when you are talking about deferred tax, you should be talking about an asset or a liability. So when we are talking about an asset, the asset has to be positive, while the liability has to be negative. And those two things has to be entered on a company statement of financial position regarding the tax owed or overpaid due to company differences, due to temporary differences. So that is what the deferred tax is telling us. Deferred tax can fall into two categories. It can either be tax liabilities, and when it is tax liabilities, the entry should be what? Negative on the statement of financial position. Or it can be deferred tax assets, and the entry should be what? Positive in the statement of what? Financial position. Both will appear as entry on the statement of what? Financial position, and represent the negative and positive amount of the tax owed. Do you understand? So that is that about deferred tax. That's what we need to understand as far as what? As far as deferred tax is concerned. So, but before we move, what led to deferred tax? Why deferred tax? You know, every company, every organization pay tax on their profits. Do you understand? Every organization, they pay tax on their profits. And this tax that they pay is charged based on the profit made by the company as adjusted according to the tax law. So the amount of tax payable in any particular period does not necessarily bear a direct relationship with the amount of profit or loss shown on the income statement. So now, the accounting profit, or let me just say the taxation of profit, is what leads to what? The deferred tax. And when we are talking about deferred tax, we should be wary of accounting profit, taxable profit, and the current tax. Those are the three things that we must understand. So first and foremost, what is accounting profit? So accounting profit is the profit or loss for a period before deducting tax expense. Accounting profit is the profit or loss for a period before deducting what? The tax expense. Why the taxable profit is the profit or loss for a period determined in accordance with the law, upon which income taxes are what? Are payable. So now, let me just do something so you'll be able to understand what I'm trying to pass across. So now let us have this. I made mention of taxable profits. So then I made mention of accounting profit. So now, then the next one is current tax. So from the view of taxable profit, I said is the profit or loss for a period upon which income tax are payable. So then accounting profit is the profit or loss for a period after deducting tax expense. So now we have the first thing that we have is accounting profit. Accounting profits. So then after which we now add if there is any inadmissible expenses. So now, what is inadmissible expenses? Then what is admissible expenses? So those are the two things that we need to understand. So then after that, we now less admissible expenses. So to arrive at taxable profit. So taxable profit. So if we less this should be jacketed. So then our taxable profit will now be addition of accounted profits plus inadmissible expenses, then less admissible expenses. So then the next thing is our tax rates. So the rate of tax for corporation for corporate company is 30%, right? So now say X rate, or let me just use percentage, X percentage. Then we now have our tax payable. So according to IFRS, this tax payable is called current tax. So if you hear the word current tax, is regarded as what? Tax payable. So that is how to get your tax. And the tax payable should be paid to Federal Inland Revenue Service. And the rate is always is 30%. So that's the thing that you need to understand as far as deferred tax is concerned before we move, because accounting for taxation, then deferred tax makes up the income tax, that is IAS 12. Accounting for taxation, then the income tax makes up, then the deferred tax makes up what is regarded as what? Income tax, that is IAS 12. So let us now proceed. I think you understand what I explained here, right? Okay. So now let us move to the manual properly. So in order to properly account for the tax effect of all transactions occurring within a period, a deferred tax provision is necessary. In this session, you will learn the meaning of deferred tax, deferred income tax, and how to account for deferred tax. So having complete this study, this particular topic, we should be able to vouch for the following. One, we should be able to define and explain what deferred tax and its terminology means. Then we should be able to explain deferred income tax, and we should be able to understand how to account for deferred tax. Let's quickly talk about the first learning outcome, which is introduction and definition of what tax terminology, deferred tax terminology. So I said something about deferred tax the other time. Don't be confused. Deferred tax can either be deferred tax assets or it can be deferred tax liability. And I said IAS 12 give a comprehensive definition of what? Deferred tax. So deferred tax refers to either a positive asset or a negative liability entry on a company statement of financial position regarding the tax that is owed or overpaid due to temporary differences. But the issue here is that SAS 19, that is Statement of Accounting Standard, that's what we have been using before the introduction of International Accounting Standard and financial reporting, International Financial Reporting Standard. Before the adventure of those two standards, we have been using what? SAS 19. But this time around, don't disturb yourself about SAS 19. Just focus on IAS 12, that is income taxes. So, income taxes. According to IAS 12, deferred tax is the tax consequences of the future recovery or settlement of the current amount of assets or liability in a company balance sheet, which also refers to as company statement of financial position, if it is probable that the recovery or settlement of that current amount will make future tax payments larger or smaller than they will be if such recovery or settlement were to have no tax consequences. So what they are saying here is that when you taking cognizance of what deferred tax is talking about, is either you get deferred tax asset, which is positive, or deferred tax liability, which is what? Which is negative. But the essence of this deferred tax is that it will make future tax payments either big or increase, or it will make it smaller than they would be if such recovery or settlement were to have no tax consequence. So, but if there is a tax consequence, is either you get deferred tax asset or deferred tax liability. Deferred simply means in future, is either your tax liability is increasing or reducing. So that is that about deferred tax. So we have operational definition of some terms. So we have accounted profit, we have taxable profit, we have tax expense, we have current tax, and we have temporary difference. This current tax is also known as tax payable. Tax payable according to International Financial Reporting Standard. So it's regarded as a tax payable. So now accounted profit is the net profit or loss for a period before deducting tax expense. Is the net profit or loss for a period before deducting what? Tax expense. Why the taxable profit? You can have taxable profit or you can have taxable loss. So is the profit or loss for a period determined in accordance with the rule established by the taxation authority upon which income taxes are payable or recoverable? I've explained this before. Then we have tax expense or tax income. Tax expense is the aggregate amount included in the determination of net profit or loss for the period in respect of current tax and deferred tax. Why the current tax is the amount of income taxes payable that are recoverable in respect of the taxable profit for a period. And before you can get your current tax, you must understand what your accounting profit is all about. That is the profit before tax, after which you add admissible, inadmissible expenses and you less admissible expenses. So once you have done that, you get what is referred to as what? Taxable profit. And from your taxable profit, you know, rate using the tax rate. So at the end of the day, you get what is referred to as what? Foreign tax, that is the tax to be paid to the Federal Inland Revenue Service. Then the next definition of terms is temporary differences. What do you understand by temporary differences? So temporary differences are differences between the current amount of an asset or liability in the balance sheet or statement of financial position and its tax base. So now what we be interested in is the current amount. That's the amount that you can find in the statement of financial position for the asset or liability. So then the next thing is the tax base. What is the tax base? The tax base of an asset or liability is the amount attributed to that particular asset or liability for tax purposes. So your carrying amount and your tax base, the difference between them is referred to as temporary differences. And these temporary differences, your carrying amount is the amount that you can fund on your statement of financial position, while the tax base is the amount attributed to the asset or the liability for tax purposes. And the difference between them is regarded as what? Temporary differences. And these temporary differences can either be taxable temporary differences or deductible. So taxable temporary differences are temporary differences that will result in taxable amount in determining taxable profits or loss or future period when the carrying amount of the asset or liability is recovered or settled. It means you recover the carrying amount of the asset or liability. So it means you covered it. That is what we regarded as what? Temporary differences. So taxable temporary differences are differences that will result in a taxable amount in determining taxable profit of future period. So now, deductible temporary differences are temporary differences that will result in amounts that are deductible in determining taxable differences of future period when the current amount of the asset or liability is recovered or settled. So now, under the taxable temporary differences, let us look at this. If carrying amounts is greater than the tax base, this is what they are trying to tell us here. So, taxable temporary differences. So, we have carrying amounts minus tax base. So we have what is referred to as taxable temporary differences. That is, if our carrying amount is now greater than the tax base, we have what is referred to as deferred tax liability under the asset side. So for the liability side, if our carrying amounts, so if our carrying amount, same thing, carrying amount minus tax base, so minus tax base, we have deferred tax liability. So the reverse is the case if the tax base is greater than carrying amount. So we have what is referred to as deductible temporary differences. So deductible for assets, we have deductible temporary differences. So in deductible temporary differences, so the tax base will be greater than what? The carrying amount to have our deferred tax assets, or for the asset side, and liability. So then for the liability side. So that is that. So this can be done mathematically. So you may want to know whether we have deductible temporary difference or taxable temporary differences. So for the deferred tax assets, let's say for the assets, now we have carrying amounts to be equals to 30,000, and we have tax base to be equals to 20,000. So what do we have? Here, our carrying amount is greater than our what? Our tax base. That is deductible temporary and taxable temporary differences. So our deferred tax liability will now be equals to 10,000. So that is taxable temporary differences. Now, the first is the case if you have our carrying amount to be equals to 20,000 and our tax base to be equals to 30,000. Here we have deferred tax for the assets too. Deferred tax, here deferred tax assets, deferred tax liability or deferred tax asset. Deferred tax assets will be equals to 10,000. So this is deductible temporary differences. Deductible temporary differences. So that is that about deferred tax. So now let us forge ahead. So let us forge ahead. So example of taxable difference, higher NBV, that is net book value for fixed asset, compared to tax written down value as a result of accelerated capital allowance. The example of deductible difference, that's the case that you can have both taxable difference or deductible difference. So when there's a provision disallowed for tax purposes until payment is made, for example, gratuity provision. So that's an example of a deductible difference. Then we have timing difference. According to IAS 12, timing differences are differences between taxable profit and accounting profit that originate in one period or reverse in one or more subsequent period. I said something about accounting profit. I said accounting profit is the profit or loss before deducting tax expense. That's the accounting profit. Then the taxable profit, that is the profit or loss upon which income taxes are what? Are payable or recoverable. That is the taxable profit. So the difference that we might have between the accounting profit and taxable profit is regarded as timing differences. And these timing differences can also be attributed to the taxable tax payment, that is the current tax. Elizabeth, please, you are disturbing us. If you are not in the class, you can excuse us. So what we are saying here is all timing differences are temporary differences, but not all temporary differences are timing differences. So that thing is a very key word. All timing differences, that is any difference between taxable profit and accounting profit, are also known as what? temporary differences. But not all temporary differences are tiny differences. And the next one here is permanent difference. We've talked about the temporary difference. We need to talk about the permanent difference as well. Under the permanent difference, these are the differences between taxable and accounting item for a period that are not expected to reverse in subsequent period. Once you have done with the permanent difference, you cannot reverse it back. Once you have gotten your deferred tax asset or your deferred tax liability, you cannot reverse it. It is permanent. Then we have deferred tax liability. Are the amount of income tax payable, income tax that is payable. Sorry, I'm sorry for the interruptions. Someone just called in. So now, what we are seeing here is we are talking about deferred tax assets. These are the amounts of income taxes recoverable in future period in respect of one, deductible temporary difference. Then two, carry forward of unused tax losses. Then the carry forward of unused tax credits. So deferred tax assets has three main components: deductible temporary difference, carry forward of unused taxes that has been lost, then carry forward of unused tax credit. Then we have tax base. Tax base of an asset is the amount attributed to that asset or liability for tax purposes. I've explained that before. So that is that about the first learning outcomes. Now let us look at deferred income tax. So deferred income tax is the same thing as income taxes, which is strictly described under IAS 12. So deferred income tax are taxes that the company will eventually pay on its what? On its taxable income, but which are not yet due for payment. That is why it is deferred. So it is going to be paid in the nearest future. So the difference in the amount of tax reported and paid is caused by the difference in the calculation of taxes in the local tax regulation and in the accounting framework that the company uses. Examples of major accounting frameworks are generally accepted accounting principles and international financial reporting standard, that is IFRS. So any tax that are payable under the relevant accounting framework, but which are not yet payable under the local tax regulation, are recorded as tax liability on a company statement of financial position until such time as they are to be paid. So that is what they are to be paid. What they are saying here is that both the deferred tax asset and deferred tax liability should be recorded inside what? The statement of financial position, and they are not currently due for what? For payment. So the tax liability is frequently recorded as a long-term liability. That's the deferred tax liability is currently recorded as a long-term liability in the statement of financial position, since there is usually no expectation of paying it within the next 12 months. That is why it is regarded as what? Long-term liability. That is non-current liability. So this means that the deferred income tax line item generally does not impact short-term liquidity ratio. That is, there's nothing we can associate deferred tax liability with the short-term liquidity. So, for example, a company may use straight-line depreciation to record depreciation on its fixed assets, but it's allowed by tax regulations to use an accelerated depreciation method in its tax return. The result is less taxable income reported on the corporate tax return, which is caused by the increased amount of depreciation expense in the current period. Thus, the company pays fewer income taxes in the current period, even though a higher income tax is indicated in its normal income statement. In later years, when the amount of straight-line depreciation recognized catch up with the amount of accelerated depreciation, the amount of deferred income taxes related to this item will be reduced to zero. what they are trying to tell us here is that deferred tax liability should be regarded as long-term liability or non-current liability in the statement of financial position. Anytime you want to get your current tax or what is referred to as income tax. So what we just need to do is that whatever the method we are using to calculate our depreciation, for instance, they are making use of a straight line method here to record depreciation on the fixed asset. But in the tax regulation, to use an accelerated depreciation method in returns. So let us look at this example. Simple as estimated its income tax liability for the year ended 31 December 2013 at 180. That is estimated value for the income tax liability. That is, this income tax liability should be recorded in the what? In the non-current liability in the statement of financial position of the simple. And the amount is what? 180,000. In the previous year, the income tax liability has been estimated to be 150. You can see that in the previous year, there is an overestimation of 30,000. So calculate the tax charge that will be shown in the statement of profit or loss for the year ended 31st December 2013. That's the current year. If the amount that was actually agreed and settled with the tax authority in respect of 2012 was 165,000. So the estimated amount is 180. The income to be paid is estimated to be 150, but the amount that was agreed with the tax authority in 2012 is 165,000 or 140. So for the 165,000, if you look at what was agreed with the tax authority to be paid in 2013 and what the estimated value is, you discover that what was agreed is less than what the estimation is. That shows that we have under provision. What was agreed is less than the estimated value. We have what is referred to as under estimation, and that under estimation will be recorded on the statement of profit or loss and other comprehensive income. Do you understand? So of 180,000 minus 165,000, what we just need to do is we just say under provision. So we have 180,000 minus 165,000. So 180,000 minus 165,000, that's 15,000. So under provision of 15,000 should be recorded, should be recognized in the statement of profit or loss account and other comprehensive income. So the second one, we have over provision of in 2012. So in 2012, what was agreed with the tax authority is 140,000. And what was estimated is what? Is 180,000. So in that case, we have, so here, so we have under provision of 50,000, which should be added back to the amount that was estimated for, which is 180. 180 plus 50,000, we have 195. That's why we got 195,000 here. So then for the second one, statement of profit or loss, what they were agreed upon in previous years, that is in 2012, that is 150,000. Then what was agreed with the tax authority is 140. So we have 10,000 as over provision to the that should be recorded on the statement of what? Profit or loss and other comprehensive income. And once you have over provision, it has to be deducted from the estimated value. Then the under provision should be what? Added back to the estimated value. So that is that about that. Then we have accounting for deferred tax. How do we account for deferred tax? Deferred tax accounting seeks to equalize the tax expense determined by the tax law, which often bear no direct relation with revenue earned. Let me just say something here. When you look at deferred tax, I said something the other time. I said deferred tax fall into two categories. So we can have deferred tax liability, and we can have deferred tax assets. The two of them, that is, both of them, will appear as entry on the balance sheets and represent the negative and positive amount of the tax that is owed. So there's one thing that I want you to understand. You should know that there can be one without the other. That is, a company can have only deferred tax liability or deferred tax assets. Depending on whether the tax is owed or paid, will determine whether it is considered as an asset or as liability. That's one thing that you need to understand. There can be what? One without the other. That is, a company can have only deferred tax liability or deferred tax assets. And I said it depends on whether the tax is owed or paid. And this will determine whether it is what? Whether it is considered to be an asset or it is considered to be what? To be liability. So another thing that you need to understand is when you have deferred tax, we said something the other time. I said all timing differences are temporary differences, but not all temporary differences are what? Are timing differences. This occurs when a business has an asset with a liability value that does not match with the current taxable value of the asset. So the temporary differences can impact on a financial account because they mean that income and expenses will appear within one accounting period, but the tax is payable in a different accounting period. So that is why we said a taxable difference can either be taxable or deductible. That is why we have taxable temporary differences and deductible temporary differences. So let me now give you an example of a deferred tax liability. You know, a deferred tax liability occurs when a business has a certain amount of income for an accounting period, and that amount is different from the taxable amount on their tax return. That's why we have deferred tax liability. This is a company, and that particular company, they have certain amounts of income for an accounting period. You know what accounting period is all about. And that amount is different from the taxable amount on their tax return. So that is why we have what is referred to as what? Deferred tax liability. And when this amount is less than the estimated tax, the example I gave you the other time, an entry is placed on a balance sheet in the form of what? So the amount enter on the balance sheet is payable. Hello, can you hear me?
Yes, sir, we can hear you, sir.
Okay. Yes, so where do I stop? Hope you hear me till temporary differences, right?
Yes, sir.
Yes, sir.
Okay, what I'm trying to say here is that let's assume we have a particular company. Do you understand? And that company is titled, let's say, ODL Limited. And this company owns a machinery. And that machinery is classified as an asset under IAS 16, that is property, plant, and equipment. So, and it's non-current assets. So this company chooses to use a certain depreciation method. In this case, we can say accelerated method that allows higher deductions earlier in ownership of the assets and lower deductions further on. So in this particular contract is very frustrating this time out. So what I'm trying to say is that, let me share my screen again. So I was explaining something. I said, let's assume a particular company is using a particular method. So to calculate its depreciation. So, and the tax authority uses another method, which is quite different from the method used by the company. You know, the depreciation method affects how much the charges will be for each accounting period. And this charge we are talking about can be claimed for capital allowance. Because the depreciation method chosen by the company, which is regarded as ODL, will result in at first a larger deduction than the method used by the tax authority. So their income will be higher than what will be considered as what? A taxable income. So in this case, the temporary difference will be added as a liability to the statement of the financial position of the company. Let me re-explain. We have a company, and that company uses a particular method to calculate their depreciation. And when the documents of that particular company are submitted to the tax authority, they use another method in calculating that particular depreciation. And you know, the depreciation method affects how much the charges will be for each accounting period. And these charges that we are talking about can be used to claim what is our capital allowance. Because the depreciation method chosen by the company, which is ODA, will result in at first a larger deduction than the method used by the tax authority, automatically their income will be higher than what will be considered to be what? To be taxable income. So in that case, the temporary difference will be added back as a liability to do what? To the balance sheet. So that is what deferred tax liability is talking about. So we have also deferred tax assets. So deferred tax asset, if you look at this example in our manual, we discover that we have the cost of equipment to be equal to 1,200. Depreciation under here we are using straight line methods 20%. Company income tax rate we are 30%. Annual profit before depreciation we have 800. Then to claim our capital allowance, we have initial allowance 50%, annual allowance 50%, and 25%. So solution. If you look at this, what I just explained is what is being done here. We have profit before depreciation and tax. How many years? We have 5 years, from 2006 to 2010. So depreciation. So here, this is straight line method. For the first one, we have 240. Then profit before tax. That is when tax has not been what? Deducted. Then after tax has been deducted, 30% of the tax, we have all this. Then profit after tax, we have this. So that is that. Then based on tax law, that is it is the tax authority that use these calculations on their own. So they will definitely have different, that is why we have timing differences. That is the difference between the income in capital, what is it called? The depreciation in here and capital allowance in what? In C here. So we have our timing differences. Then deferred tax will now be on our timing differences. So that is that about so accounting treatment plus tax treatment equals temporary difference, which can be regarded as what deferred tax are required by. So how do we recognize deferred tax? How do we recognize deferred tax? So that's the next line of action. And then enterprise should account for the tax consequences of transactions and other events in the same way that it accounts for the transaction and other events themselves. Thus, for transaction and other events recognized in the income statement, any related tax effects are also recognized in the income tax. Then the third one, for transaction and other events recognized directly in equity, any related tax effects are also recognized directly in equity. So IAS 12 refers require that the deferred tax assets be recognized when it is probable that taxable profit will be available against which the deferred tax asset can be what? Can be used. this issue of my network today is somehow. So now the next thing here is what are the methods of computing deferred tax? So it might be either the efficient basis. So under this method, we have deferral method and we have liability method. And those are the two methods that we have. So then what are the steps or approaches to calculate deferred tax? So the first thing is we determine our carrying value. So we compute our income current tax. That is, how do you now base that is an asset or liability that's attributed to that particular asset or liability. So then we calculate our temporary difference. So temporary difference between the current amount and the tax base. So we identify exception if there's any. So we review deductibility of the difference. Then we apply a relevant tax rate. Then we recognize the deferred tax. Then we now present it to the company. So determine carrying value, computing income current tax, determine tax base, calculate temporary difference, identify exception. So we use image to represent that. So that is that about study session 4. So we have learned the following: deferred tax, what deferred tax is all about, what accounting for taxation is all about. Then we discuss deferred tax assets and deferred tax liability. Then we talk about the deferred income taxes, and we talk about temporary differences. It might be taxable or deductible temporary differences. Talk about the method used in computing deferred tax assets or liability. Those are the things that we need to understand as far as this course is concerned. So if there's any questions, reactions, comments before we call it a day, please. The floor is open. Thank you. Hello. Hello.
Hello, sir.
No questions, no reactions, no comments, all right?
The job study section 3.
Is that?
Good morning. Yes, sir.
Good morning.
Yes, sir.
I'm
Hello, sir.
listening. Hello.
Yes, sir.
I'm
Please,
with
can
you.
you throw? Yes, sir. Please, can you throw more light on? You said all timing differences are temporary differences, but not all temporary differences are timing differences. Please, can you throw more light on it?
Okay. When I explained what temporary differences are all about, I said temporary differences are defined as being differences between the carrying amount of an asset or liability in the statement of financial position and its tax base. Look at that word. Carrying amount and what? And the tax base.
Tax base.
The difference between the two is regarded as what? Temporary difference. And I said temporary differences can either be taxable temporary differences or deductible temporary differences. Please try to listen very well. When we are talking about taxable temporary differences, there are those differences on which tax will be charged in the future when the assets or liability is recovered or settled. But deductible temporary differences are those which result in tax deductions or savings in the future when the asset or liability is recovered or settled. What am I saying? If you look at timing differences is talking about the difference between the carrying amount also and the tax base. That is why I said all timing differences are temporary differences. But not all temporary differences are timing different, because if temporary differences is deductible temporary differences, it is no longer timing differences. But if timing differences, if temporary differences is taxable temporary differences, it's still the same thing as what? Timing differences. I don't know whether you get it.
Yes, sir.
Or you want me to re-explain?
Yes, sir, I understand it now.
Okay.
Please do.
Any other question?
Hello, sir.
Hello, ma.
Please substantiate more, sir.
You said what?
Please kindly.
Who was the last speaker? And someone was trying to ask a question. I cannot hear that person. In the absence of questions, reactions, comments, I think we can call it a day. Right?
Okay, sir.
Okay, sir.
Okay, thank you.
Thank you so
Take
much.
care of yourself. Bye-bye.
Bye-bye, sir.
All right.
Bye-bye, sir.
Bye.